Hello and welcome. In this video we will have a look at Jungheinrich, quite a boring stable company, but how can you use the stock market for fluctuations to get at least 15%, maybe even 20% if you buy it cheaply enough? Because even here in this super stable business, the market fluctuates a lot. And I'll share with you some opportunities historically, maybe that will apply in the future. And I'll share with you what is this kind of company about. And I can begin here with a story that when I was around 15 years old, I had my first summer job working in the warehouse. And this company is, of course, the leading manufacturer here in the warehousing forklifts. And I recognize these forklifts in the warehouse, and I saw that all the warehouses I saw later also, and it's very common to buy these. And I figured out later, actually, if I would just save my money as I did back then also, and put it in the market in such a nice growing company, just a good leader in the forklift market, then back then I think I saved maybe $6,000. Yeah, $6,000 working in the warehouse during the whole summer. If I would just put that aside there and let it grow and be a part owner of this company, I would have actually had more than 14% annual return with dividends included. And I figured out that yes, working a summer job and saving it, it's more than 20 years ago. But that if I would just let it grow, it would those $6,000 saved would actually amount to $6,000 annual financial income for me right now. I would earn that on a yearly basis. Actually, you can do the math there, but I would have got approximately 2,000 shares from the summer job, and that would earn that to the owners every year. I'll show you here how much this company fluctuates, but first let's have a look at the numbers. The last 10 years, you see the gross profit and the operating profit, operating income. Nothing special, but just they just grow and grow, and has been a double increase here in 10 years, from 200 million euros to 400 in 10 years. And you also see that they just grow their equity in their machines. They build equity and retain the earnings, and then they also do it profitably. You can see here that the return on equity and return on tangible assets are very high, better than the average of most businesses. And you see that it's always around 14% at least or so return on equity, and this is done with a very low debt. For example, you can measure the operating profit compared to the interest expense payments. Always a very high multiple, which indicates that they've been on the safe side. So here I said in the video here that could you earn 20% or at least 15% if you buy the shares cheaply? Yes, at least historically. I can show you here that it fluctuates a lot, even with these stable numbers. You can see you could have invested in a long time here back in 2017, and then suddenly you would see that your net worth in this company would fall by more than 60-70%, it seems. And you would have to have quite a stable temperament, I would imagine, if you're gonna have a look. If you're opening the stock market portal and you see that your net worth has fallen so much, and then maybe you would be scared and sell, but then a bit later it's up again to all-time high, and then you see it fluctuates and fluctuates. But if you just have a look in the annual reports and you just see the numbers, if you zoom out and you just see the growth year by year, and you didn't look at the stock market pricing, you didn't care what other people are selling and buying the shares, which price they are offered in the market, you'd maybe just have a look at the dividends per share, for example. You just see that the dividends are growing and growing, and then it's in comparison with the revenue, and nothing has changed with the amount of shares outstanding. Then it's really surprising, I would say, that the market is so erratic and yeah, just like the Mr. Market analogy of Ben Graham, sometimes the Mr. Market is just very pessimistic and sometimes very optimistic, and huge differences in what the prices are trading at. And if you're an intelligent investor and you just have some kind of opinion or based on your analysis, what is the share price, what is a good share price and what is a good price level, maybe you can make a better return here. I'll show you how much you would earn, maybe at least 15% a year historically, maybe 20% if you just bought the shares when they are trading cheaply. In this graph in FinChat, by the way, there's a QR code if you want to try this for free, and you also get 15% discount on the portal to support the work here. And much appreciated. But here you can see it's an average PE ratio of this company at around 15. And you see it's wild how much it swings here. For example, in the 2020 year, it would be dropping as close to 6-7 in price earnings ratio, and then up to 26-27 later. But this is really, in my opinion, just giving the investors a lot of opportunity to just have a stable temperament and just use it as an opportunity to maybe increase your ownership in the business when other investors are selling it cheaply, and then maybe if you are inclined to sell a bit when they are being way too optimistic, maybe. But in the long term, they have, you see, they just build their equity over a long time and have a very good above average return on their equity. So let's see here, if we have a look at the historic price, at least how it has been in the past. We see here, for example, that if you would have bought at the price earnings ratio of, let's say, 8 in this company, or a price book ratio of maybe 1.1, 1.2, how much would you earn? And here we can have a look, for example, in May 2020. That seemed to be a good price entry point. And let's see how much you would earn with dividends included. Just buying an above rated company at a lower price to book ratio or price to earnings ratio, and just hold them for the long term. So let's have a look here. If you bought it in May 2020, around there, that price book 1.2, historically, your annual return, you can measure the total return with dividends included. You would actually have earned more than 20% a year on a very boring business that just doubles its earnings in 10 years. You see roughly here, the 10-year diluted earnings per share growth, 8.5%. So there, it's really some opportunities here, and you can also see it here if you bought it back in 2022, also around 1.2 in book value, price to book. You would also have opportunities here, but you also see, of course, it fluctuates a lot. So on the short term, it's very hard, I think, for investors to own this. But if you just, here, for example, if you bought it 3 years ago roughly, and the price now is not really, it's below average even now. So just an example here that your total return, including dividends, would be around 20%. So this is very interesting to me, and there are many opportunities here to just try and find a company and understand it. Here it grows very stably, and you can, for example, see here that the capital expenditure is in line with the depreciation here. So in my simple analysis, I would say that the net income to the shareholders are roughly not far from the owner's earnings, really. And you can see that, you can also have a look at how well they are deploying capital, for example. Just have a look, for example, they have retained 1.5 billion euros over 10 years. And you see that the market cap has grown a little bit less, but I think it's a bit undervalued. So in my opinion, it looks like they're allocating the capital well, for example. So just something to understand here, but I would go through and understand the company and read the annual report and understand the business model. This is just an example of a very simple business, really, and then have a guess. Will the future in 10 years look about the same for Jungheinrich? Will they still be using forklifts, their technology to operate in warehouses, etc., or does it change a lot? That's of course can be hard to tell. It can be, or it can be a no-brainer. But the lesson here, for my lesson, in my opinion, here is that it fluctuates so much, and if I just buy the shares when they are on the average cheapest side, maybe I would get better returns than the market here. And I can also share that if you see here that if you assume that the company is well financed, you see that with a return on equity of around let's say 14% or so, and they retain half of their earnings into the growth of the business and half of the earnings into dividends. You can have an estimate here. If you buy the price at let's say price book, a PB ratio of 1, so price book 1, then maybe would be close to getting the same return on equity as the company has, adjusted then for dividends, but it's and then have a relationship with the price to earnings and price to book is useful here, I think. And I would love to have a notification which is dynamic here. If I could, I'm thinking about developing something for you and the viewers here, to have a watch list of our most the companies we feel we know the most, and then the user can input that he wants to have a notification when the price book or the price earnings ratio, for example, is at the lower end here, for example. And I say dynamic because the earnings increase every year and the book value increases every year, so it's hard to just put a price level and get a price alert because it will grow over time. So it's you can do it, but it's a bit manual work. But I would love to have this as a dynamic, call it a dynamic price monitor or price alert. So if that's interesting for you and you like that idea, feel free to reach out to me, and maybe we can try and develop a simple dashboard for that. And then we can monitor these very stable market-leading companies and get notified when they are priced at the cheap side. And maybe we make more return than if we buy them more expensive, of course. So that's the idea there. So thank you for watching all until the end of the video, and hope to see you in the next one.